Okay, so if you sit comfortably, I'll be done in about 4 hours. Um, I think effectively the way to think about it is private equity is buying into significant established businesses. So sometimes it's easy to conflate it with venture capital or growth equity, but actually these are different things. So growth equity and venture are really buying much younger businesses with much less proven models or operating in as yet really undefined markets. Private equity is the sort of the boring elder brother, where these businesses all are established, they're all profitable, and increasingly of significant scale, that are bought. But the big difference is they're not listed on a public stock market. So if you think about the UK, there's around about 1,000 companies listed on the public stock market. And if you think about the addressable universe of private companies of real scale, it's probably 10 times that. It might be 15 times that. So, I mean, it sounds a bit obvious, but there's just an awful lot more private companies than there are public ones. And what private equity does is tries to operate in the environment of the larger privately owned businesses that are out there. Just the easiest way to think about it. Investment companies that have a private equity focus is what you're really referring to. And what they are trying to do is capture the investment opportunity that is available in buying private businesses that are mature and established, but then wrapping them up in an investment company structure, which is obviously a very well known, well understood structure, been around for a very long time, and giving access to, if you like, any shareholder, into these businesses. So the the typical private equity model, with the mechanism for accessing it, is through a thing called a limited partnership, and that's very much the purview of the very large institutional investors. So the biggest sovereign wealth funds in the world, the biggest pension funds, and these structures are designed for multi-million pound investments per investor, so completely inappropriate for private individuals. So the trick with the investment company structure is to take the same investment opportunity, exactly the same investment opportunity in certainly HG's case, but then to put it into a publicly listed structure, which is available like any other publicly listed share on the London Stock Exchange. So, the price of a share is a matter of pounds, not a matter of millions. So the genius of it really is taking these investment opportunities, which are really out of scope for most private investors, and making it available to a very broad shareholder base. That's the trick. Well, that's a big question. Let me try and frame it a bit. So I think the private markets, as they are defined, are actually pretty small. So if you think the private markets, everything everywhere globally, including all the venture and growth piece that we talked about, and indeed infrastructure and real assets, say it's $10 trillion. It sounds like an enormous number. The public bond and equity market is about 200 and something trillion. So it's a relatively small part of the global cake of assets that are available. What has been happening has been, over time, the relative share of private investments has risen. So the market has grown, and that relative share has risen predominantly because the core customers, who are those big institutional investors that we talked about, have actually demanded more of it. And the simple reason they've demanded more of it has been it's worked. So the performance that has been generated has been sufficiently compelling that they've sought to increase what they allocate to private strategies. And that's really, as I said, been driven by the performance that it's delivered. And if you look now, you will see a very wide range of asset allocations to private markets amongst institutional investors. And some are well above 20%, some are even higher, particularly endowments that are typically tend to be very heavily invested in private markets. So the simple answer is, like, the reason why to consider it is actually some of the largest investors in the world have actually deemed it to be a really pretty compelling opportunity, to the extent they've doubled their allocation to this over the last 10 years or so. So there's a real performance advantage. And well, that would be my opinion. And I would say, I mean, part of the reason behind that is, and I speak as a reformed fund manager from many years ago, the way private equity creates value is actually I would call it more fundamental than anything else. So if you look at a typical private equity business or our underlying investment, what the private equity manager is trying to articulate when they buy something is, are we absolutely clear on what we're buying? Do we really understand every dynamic around this business? And how much time have we spent to think about that? And to give you a sense of it, um, if you look at HG as an example, the kind of lead time that we would have on an investment is years. It's several years. And if you think about the typical lead time that a public market investor has on an investment, it's not several years. So and again, the other thing is the access to the company that you have as a private investor. You can get actually pretty deep access to a business. And actually, as a public investor, it's increasingly difficult to get that because of the rules on insider information. So private investors have more time to make better decisions, would be my thesis on the way in. And then when they actually do invest, they nearly always, and pretty much always, have a thesis around what the full potential of the investment that they're investing in is. So what can we really do? What can we really do to transform this business that we're buying? How many levers can we pull? How many ways to win do we have? And then increasingly what you find is great private equity managers, investors, try and go back over the same playbook over and over again. They'll try and build what they would call a repeatable model. So how many ways have we got to win, and how many times have we done this before? And they'll look through that lens of whatever they buy to be able to understand the journey that they're willing to go on and the way they're willing to support the company as it grows. As the company grows, again, the other difference is private equity organizations like HG, for example, the team that we have to support the companies as they grow is almost as big as the investors that decide what to invest in the first place. So there's actually a huge support organization to help these businesses achieve their full potential. And they are staffed with people who know how to do this. And they've done it a number of times before. And again, that's different. And then probably the final point, which is kind of the one that's the best one-liner, basically, is the other thing with private market investments and private equity investments is it is the only asset class in the world where the insiders make the liquidity decision. So if you are thinking about our current environment and public market volatility, which is obviously extreme at the moment, it's a nightmare to know when to sell. So the current environment is exactly case in point, where we've had a bounce from the bottom, share prices have risen. What do you do? And actually really difficult as a public market investor to really know what to do, because to some extent you're trying to guess what everybody else is doing. In private markets, what you do as an investor is you basically say, I accept the illiquidity of these underlying investments and I outsource the decision to make a liquidity event to the insider, who will only act at the optimum point of interest or optimum value creation point. And the price you pay for that is illiquidity within the typical limited partnership structure, not so much in a listed structure, I'll come back to that. But you outsource that decision to someone who's a far better position to make that decision than you will ever be. So that's part of the secret. And what that really means is, again, if you look at our portfolio in HG, the number of businesses that we invest in where we lose money is minimal. It's a tiny percentage of what we invest in. We actually return less capital than we used to buy the business in the first place, which is, again, a very different picture to what you might see in the public market. So, it's a very different model, but kind of broadly invest in companies, which is where the similarities exist, but the actual mechanics and the structures of it are very, very different. And because of these structures being different, the tools are different. So, there's more leverage in the system, but I would argue that the amount of leverage in the system is not egregious to the extent that we see very few companies getting into trouble because of a bad balance sheet construction. So again, private equity is generally pretty good at understanding what the limits are and how far to push. And fundamentally, they don't want over-levered businesses because they need these businesses to grow. And if they're over-levered, they won't be able to grow. So it's a sort of it doesn't help you very much if you over-lever something, and therefore they don't anymore. And then final point, in terms of portfolio and correlation. So this is equity, right? So it's not uncorrelated. You would say it probably has a lower correlation. And part of that is a structure, a mathematical outcome, because private equity portfolios are not marked daily. They don't mark to market every day. They're typically revalued every quarter, and they're revalued against a basket of comparable companies, mostly, well, sometimes public, sometimes private, and M&A transactions. So there's the way that the valuation metric gets created is a definite damped effect. Now, you would argue that the volatility, which is lower, is definitely, you can't apples to apples that with the public market. It's just impossible to do that. So you shouldn't look at the risk metric and understand private equity is less risky because it's lower volatility, because it has to be lower volatility. It's mathematically impossible for it not to be. But that's a bad comparison. I think the way I would think about risk in private equity is, what is your actual experience of losing money? And your actual experience of losing money in great private equity firms is very, very low, to the extent that some are at zero. So some of the leading private equity firms of the world, thinking of one or two in particular, haven't actually lost any money ever in their history, which is pretty compelling. So from that sense of risk, I mean, that's how private equity risks are different to public market risks. And so this won't move in correlated with your public portfolio. It will move somehow correlated to it with a lag, or some kind of a lag, but it will not move with it. So there's a sort of an advantage to that in your portfolio construction. Yeah. So in terms of HG, for us, it has been very much a case of business as usual. So you will be aware that we predominantly invest in tech-enabled business services and software, particularly cloud software, SaaS software. We've done that for a decade or more, and actually no changes to any of that. So the fundamental investment thesis that we have, and the way that we invest, which is across 8 different clusters of industry subsectors, predominantly in Europe and some into North America, business as usual. And I would say the impact of what the last year has thrown at us has been, at one level, we've been remarkably resilient to it from the portfolio company level. So the underlying portfolio companies that we own have been very strong through the whole disruption, probably because of what they are. So they are typically market leading. So they have market leading positions, and they often operate in fragmented verticals, industry verticals. So that means that there's a great opportunity to build scale through buying smaller businesses that are less robust than they are. And the M&A machine of continuing to build relative scale, because relative scale really drives profitability. So the more relative scale you got, the bigger you are relative to your next biggest competitor, the more market power you have and the more pricing power you have. So that thesis is absolutely still intact, and they've continued to sort of exactly follow that rhyme. So portfolio company, actually no change to the structure of the what or the where or the how. And our current experience is actually things are okay. So we're obviously we're in closed periods, so limited to what we can disclose. But I think it's safe to assume that there's nothing radically different to what we said the last time we talked to the market. In terms of the machine, so the machine is always buying and selling, as well as the good stuff in the middle. Machine is still maintaining its operating cadence, so it's still doing what it was doing. You would say probably a slight slowdown in terms of the number of things that are going through the system. Not a surprise given the environment, but the machinery is still operating. And again, HG are being pretty cautious around where they want to invest, just because of the elevated risk environment. So it's not these things are completely immune. So you just have to be very certain and sure what you're owning, and we're looking to own, and that's exactly what they've done. But in terms of the in and outflow, again, no real change to the overall picture. Just a sort of probably like the speaker dial has been turned down a couple of notches from sort of an 8 to a 6, something like that. But other than that, absolutely no change. Nothing different to what it was 6-12 months ago. Sure. So I mean, outlook for PE more broadly. That comment I made up front around the sort of relative share of the cake that private markets or private equity is taking, and its likely direction of travel, that seems pretty well set to keep growing. I mean, I work with other firms, some of them who would have a real point of view on that, and a place to have that point of view from. And they would say, we're expecting private markets to, over the next 10 years, sort of double in a bit. So 2.5x from here. Why is that? Well, investors are still very under allocated to this relative to what they could be, and that performance, which has driven the growth in the past, seems to be still relatively compelling. So the aggregate picture for private markets is a pretty good one, I think. There will be some kind of indigestion over the next year or 18 months or so. But again, if you look at what is being reported by some of the leading names, and in private markets, the largest investment companies in private markets are themselves often quoted. So you have Blackstone in the US or EQT over in Europe. If you just read what they're saying about what's happening in their own businesses, then I think you would reasonably expect that the future path for private investments is a pretty good one. And we should expect things to grow and to develop. And in terms of HG and what we would do, and we will follow the path. I mean, there's no sense of any difference really there. I mean, that's a strong franchise with a pretty good market position in a key sector, a key area, which is very well run, and it should continue to be able to benefit from the growth of the market.